Hi guys. Hi guys, welcome back to day 16. Now today we're going to cover two topics that are both very important but kind of one-offs, so I figure we'll just make a video and explain both of them. The first topic is diversification. Now we briefly discussed diversification before in that you don't want to put all your eggs in one basket. So for instance, if you own one stock and that stock goes down 50%, you just lost 50% of your total portfolio. So don't do that. But if you own 10 stocks, all starting out with the same amount, and one of them goes down 50%, but the rest of them stay roughly the same, then you only lost 5%. I don't know about you, but I'd much rather lose 5% than 50%. This is one of the main reasons people invest in ETFs and mutual funds, because they hold a lot of stocks, and thus are well diversified, right? Not necessarily. If you own a mutual fund that holds nothing but German stocks, for example, you're really tied to the German economy. There are mutual funds that hold nothing but Russian stocks, or stocks of emerging countries in Africa, or Chinese companies, or Indian companies, or microcaps, really small companies. In other words, just because you own an ETF or a mutual fund, it doesn't necessarily mean that you're well diversified. You can have one thing that goes wrong that can affect all those stocks in that particular mutual fund, depending on what kind of mutual fund it is. So how can you diversify? Well, there's a few ways. The most famous one, the most known one, is by sector. Now, what is a sector? A sector is just a distinct part of the economy at large. Sectors can be things like information technology. Companies like Microsoft fit into that. Or it can be consumer discretionary. That's things you want but don't necessarily need, like Starbucks. Or healthcare, think of stocks like Moderna, or financials like JP Chase, or industrials like Caterpillar and John Deere, or manufacturing, or energy. We got a lot of sectors. In general, a company in one sector is generally insulated from companies in other sectors. For example, let's talk about First Solar. First Solar is in the energy sector. They make solar panels. Let's say they're having issues getting the raw materials that go into making solar panels. Just to be clear, this is a theoretical exercise. First Solar doesn't have any problems like this as far as I know, so this is just a what-if scenario, okay? I like First Solar, by the way. I'm invested in First Solar. First Solar, good. Now, unless these same materials go into making drugs, I don't think Moderna is going to be affected. I'm pretty sure people are still going to be playing Minecraft. Other solar companies, on the other hand, may be affected. They may have that same issue. But companies like, JP Chase probably go unaffected. In other words, the problem's more of a sector issue. In the energy sector, oil prices are the same thing. If oil prices come down, the oil companies lose money, but it also makes people less inclined to buy solar panels because, hey, they can get oil on the cheap. I'm not saying that's right, I'm just saying that's how a lot of people think. Let's say Moderna has some issues procuring some ingredients for their drugs. That may also impact Pfizer. To be clear, same here. There's no such thing with Moderna or Pfizer right now. Any other examples I give like this, these are all what-ifs. These are all theoreticals, okay? Don't sue me. But people are still going to play Minecraft. In other words, things that happen in one sector generally don't affect things happening in another sector. But that's not always true. Let's take Alcoa as an example. They produce aluminum. They're in the manufacturing sector. Suppose they run into issues producing aluminum. That's going to affect Boeing and the industrial sectors. They make airplanes. They use a lot of aluminum. That's going to affect the car makers that use aluminum. That's going to affect Coca-Cola. They use aluminum. There's a lot of companies, a lot of different sectors that use aluminum. Let's say, God forbid, something happens with JP Morgan and Bank of America and in the financial sector. And let's say they run into hard times. Well, they may be less inclined to hand out loans, in which case it becomes harder for anyone to get a loan. That can really crush the economy. That can affect all sectors. If people can't get car loans, they don't buy cars. If people can't get a mortgage, they don't buy a house. So it's generally a good idea to own lots of different stocks in various different sectors. That way, if a sector-specific issue happens in one, say high lumber prices, it happens with the home builders, that doesn't necessarily affect the technology sector or many other sectors, okay? But not every stock fits nicely into just one sector. For instance, Amazon.com. Are they a technology company? Are they consumer discretionary? Berkshire Hathaway, they own railroads and insurance companies and all kinds of stuff. And that's okay. A company like Berkshire Hathaway is self-diversified. But I digress. The point is that you should try to invest in multiple different companies, each in different sectors, so that you have no more than 20% of your portfolio, or at least your new money, going into any one sector, okay? That way, if something crazy happens in that one sector, like low oil prices that will bring down the energy sector, the rest of your stocks are unaffected. In fact, that actually may help your other stocks, because if oil prices drop, that means, generally speaking, gasoline prices drop, which means less money people have to spend on gasoline, which means more money they can spend on other things. So it sucks for the energy sector, but it's good for everybody else. One of my heroes, Jim Cramer, says over and over again, diversification is the only free lunch. He even has a segment on his show, a recurring segment called Am I Diversified? Just to drive the point home. It's very important. You need to stay diversified. But diversification isn't limited to just sector. For instance, you can have nothing but IPOs, initial public offerings, that are in different sectors, but those are kind of companies that tend to trade together as well. There's only certain types of investors that would buy IPOs. You could also have a lot of different sectors that are nothing but Israeli companies. Well, that's great, but they're all Israeli companies. That's not very well diversified. So when you look at diversification, take other factors in consideration as well. I like to also think in terms of market cap, how big the company is. It's good to have some bigger companies, some smaller companies, some mid-sized companies. It's also good to think about location. I like most of my companies to be in the US, but it's good to have some in the other parts of the world too. So if you want to learn more about diversification, watch this video. It's pretty good. But later on, if you become a really good business person and you're very good at valuing businesses, you don't have to diversify.
Wait a minute, that flies in the face of everything you just told us.
Not really. You, right now, need to diversify. You're not very good at valuing businesses. But if you get really, really good at it, and you can know that this business is almost certain to do very well over the long run, and you can buy their stock at a good valuation at a decent price, then why do you need to diversify? For example, Warren Buffett. He hates diversification for the sake of diversification. He looks at every business on their own as just that business, and he values that business alone. He doesn't think about it in terms of the overall portfolio or anything else, which is fine. When you really, really understand a business, you can do that. But you're not there yet. I'm not there yet. It's okay. Most people aren't there. Most people aren't Warren Buffett. Jeff Bezos has all of his money in Amazon.com. He knows Amazon. Elon Musk has the vast majority of his fortune in Tesla. He knows Tesla. Warren Buffett, same thing. Berkshire Hathaway. They know their businesses. And later on, if you're really, really good at valuing businesses, you can do that too. But until then, stay diversified. But if you are curious as to Warren Buffett's thinking on this, check out that video. Okay, on to the second topic. Dollar cost averaging. This is a very important topic because you will use it a lot in your career when you invest in your retirement plans, and it's just a good idea in general. But what is dollar cost averaging? Think of it this way. You can invest in stocks a couple of different ways. You can just buy it all up front. You can also buy a little now, then wait for a quarter, then buy more later. Or you can just buy as you can, as you get a paycheck, for example. When you get a paycheck, you can just take 10, 20, 50% of that paycheck and have it go directly into your portfolio, right? You remember Mr. Market, right? He tends to make stocks go up and down a lot, right? That tends to happen. So let's say you had $300 to invest, and you invested all up front in this stock that goes down a little bit, then back up a little bit. Is it $10 a share, then $8 a share, then $12 a share? If you did it all up front, in $300 you put into your stock, at $10 a share, you'd have 30 shares, right? $30 shares. Now, suppose you didn't do it that way, but instead you dollar cost averaged. And you bought $100 there, $100 there, and $100 there. You're buying $100 every month. You spend the same amount of money either way, right? $300. But how many shares do you have at the end? Well, how many shares do you have here? $100, $10 a share would be 10 shares. That's 10 shares. And then $100 at $8 a share, that's going to give you 12 and a half shares. And then $100 a share at $12 a share is going to give you roughly 8.33 shares. That's going to give you 30.83 shares. In other words, you got more shares for the same money than you did if you just bought it all at once. Now, of course, if the stock goes up like a rocket and just never goes back down, you're better off buying all at the beginning. But most stocks don't do that. They tend to jumble around. They tend to zig and zag, and Mr. Market tends to take them up and down on a wild roller coaster ride on the way up. But notice the beauty here. You bought more shares, 12 and a half shares here, when it was lower in price You bought fewer shares, only 8.3 shares or whatever, when it was a higher price. In other words, you buy more when it's lower and less when it's higher. That fits beautifully into the buy low, sell high mentality. You're supposed to buy more when it's low, buy less when it's high. If you're always buying, at least. Dollar cost averaging, it allows you to do that. Remember day 10 or so? Day 13. When we're discussing all the things you should ask yourself before you buy a stock, and one of them is now a good time to buy? Well, with dollar cost averaging, you don't really have to ask that. You can just buy a little bit at a time as you get money. And as you do that, even if it goes down way in price, then you're just buying more and more shares at a lower and lower price. That's a good thing. Quick aside. It's been a while since we've done one of these, huh? This also isn't a very quick aside, so my apologies. Dollar cost averaging is built in automatically into most people's retirement plans, known as 401ks or 403bs and things like that at their workplace, okay? How that works is you decide as an employee how much of your paycheck you want to go into your retirement plan. Then every paycheck, your company will take out that amount. It can be a given amount or it can usually be a percentage, say 10%. Your company will take that money out pre-tax, which is key, lowers your tax bill that way at the end of the year, and that money goes into a tax-deferred account where you can select among an array of mutual funds and invest the money. Now on the surface, I'm not a huge fan of this, personally. That's just for me. Number one, because I think our country is so far in debt, we're going to have to pay for it later, so they're going to have to raise taxes eventually, either that or declare bankruptcy. So the tax deferred thing, I'm not necessarily a huge fan of that, because they're probably going to pay more in taxes later than we are now. And I'm also not a big fan because they're always mutual funds. You have no choice. You have to invest in mutual funds this way, because they're the only ones that allow you to do that on a recurring basis. You can't do that with ETFs. And you know, I'm not a big fan of mutual funds. They tend to have higher fees. You can't trade intraday with them. I'm just not a big fan of mutual funds. But there's a massive advantage here to doing it this way. A lot of times employers will match your contributions. A company may match something like 50 cents on the dollar for every dollar you put in, up to 6%. So you put in 6% of your salary, they'll kick in an extra 3%, which is 50% of that 6%. So now you got 9% invested, even though you only kicked in 6%. That's an instant 50% gain. How else can you invest where you automatically get 50% right off the bat? Let's put some real numbers behind this. So let's say you get a $5,000 paycheck. You take out 6%, which would be $300, and you want that going to your 401k plan. You have that taken out before taxes hit on it. It goes and will go to your plan, but your company will match $150, which is half of that, right? And then you'll get up with $450 in your retirement plan. So every paycheck you have $450 automatically. That's 9% of this. That's pretty good. Of course, you know you should be investing 50%, but that's okay. If you can get the company to help contribute, less effort on your part. So you end up with a paycheck of $4,700 instead, which isn't so bad. It's like you made an extra $150 for free. Pretty good. So back to dollar cost averaging. There's one other big advantage dollar cost averaging has over lump sum or any other type of investing where you're just kind of waiting and waiting, is it helps you build a mentality of always investing. It helps build your mental fortitude. Remember, Mr. Market, makes these wild swings in the market, right? Well, when things are really low, people are panicking. People are fearful. It's easy for that to become contagious and you to get fearful too, and then you don't want to buy because you're scared everything's going to collapse, even though that's the perfect time where you should be buying. Same thing when the market's going to exuberant levels, it's going really crazy. Everyone's really happy. Everyone else is buying like crazy. It's really the wrong time to be buying. The market's high, you should be selling or at least not buying anymore. But it's really infectious though. People start going, yeah, I want to buy more, want to buy more, want to buy more. Buy more, buy more. Next thing you know, what are you doing? Buy more, buy more. So you want to get out of that mentality. You want to decouple yourself from the way everyone else thinks. Have them put aside. And by just buying on a regular basis, you're buying in lows, you're buying in highs, you're buying more in lows, less in highs. And it builds a mentality to where you're just always buying. You're not afraid to pull the trigger. You're not afraid to buy when things are low because you're used to doing it all the time. The more you do something, the more you get used to it, the less scary it is. If you want to learn more about dollar cost averaging though, check out this video. It's pretty good. That's all for me this time. Now you know a little bit more about diversification and dollar cost averaging. No homework this time. Enjoy.